Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, I'm Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree Point of View, our podcast. And today I'm joined with Jason Watkins, who's a partner with Novogradic and an expert on opportunity zones. And I know, Jason, you've spent a lot of time around the opportunity zone program, and today we're going to talk about op zones because it's been big in the news, but would love for you to maybe, Jason, start out by just giving a little bit of your background, but then let's talk about op zones.
Sure. As you noted, I'm a partner with Novogradic and Company. We're a full-service national accounting firm. I'm based out of our Alpharetta, Georgia office, which is a suburb of Atlanta. I've been involved in the opportunity zone space very heavily for the last 8 years. Our firm formed an opportunity zones working group, which is a collection of stakeholders in the OZ industry, consultants and attorneys, accountants, et cetera, that work very closely together to come up with best practices for use in the industry, as well as making recommendations for a lot of what we see in the Opportunity Zones 2.0 legislation, as well as helping to craft the regulations that will have been finalized to this point and that will be necessary to be added to make the new legislation work properly. We formed that group back in 2017. I chair that group. And then, as I mentioned, we're a full-service accounting firm, so I do lots of financial statement audits and tax returns, consulting, opportunity zones compliance for qualified opportunity funds, opportunity zone businesses.
So what's your take? I know Tim Scott has been a big supporter of the Op Zone program, Cory Booker. So two different senators, from one's a Republican, one's a Democrat, so there's bipartisan support across the program. With the new, at least what's coming through the Senate and what you expect to eventually pass through the House, assuming it does pass through the House, what do you think happens with Op Zone Program 2.0, the new program, as it passes through?
Right. Well, the legislation is very exciting because, first off, we now have permanence with the incentive, assuming that the Senate version passes through. The House version originally called for a one-time renewal of the incentive, so a new round of opportunity zone designations, another 7 years or so of investments would be able to take advantage of that. With the Senate version, that was changed to permanency. So there's now going to be just rolling. Every 10 years, there'll be a new map of opportunity zones. We're really excited about that. That permanence, I think, helps to give some assurance to stakeholders out there, but this program is around to stay, allow for it to be used more as a planning tool. Whereas this is sort of a one-time test. This first time around, a lot of investors took advantage of it. A lot of investors did not, especially once they sort of learned about it. Some of the incentive had lost its value anyway, just because of the passage of time. Now with this permanence, we think that goes a long way. So we're very excited to see that. Another new aspect, I mentioned that as time went on, a lot of the value of the incentive was lost. So the way the OZ incentive works is that when investors invest a capital gain into a qualified opportunity fund, they get to defer taxes on it until a later date. Under the original incentive, that date was December 31st, 2026, and it still is for these original investors. So as we got closer and closer to 2026, it's a little bit less of an incentive for investors to invest. With the Opportunity Zones 2.0, that now changes. Now every investor is entitled to a 5-year deferral. No matter when you invest, you get 5 years of deferral before the taxes are due on the gain. So now that's going to be a consistent value.
Just one question. So is that like that 5 years? So if I invest in 2025, is it 2030, or am I still under the old program where 2025
right now, this is one of the issues that we do see with the way this new Opportunity Zones 2.0 is being rolled out, is that for investments through the end of 2026, currently, those investors are still going to have a 2026 recognition date for their capital gains. The 5-year deferral will only kick in for investments after December 31st, 2026 into funds.
I know there's some discussions about like certain zones maybe changing. Do you see any drastic changes there, or even certain zones being like rural submarkets getting more favorable treatment?
Well, okay, so the House version of the bill was going to require that 1/3 of all census tract designations be located in rural areas. That language was not included in the Senate version. So we'll see what happens when it goes back to the House, if they try to put that language back in or not. With the abbreviated timeline that they're looking to pass this, I don't anticipate there being a lot of changes, but perhaps. So yes, there will be likely significant changes in the Opportunity Zones map. For one thing, the original designations were based off the 2010 census map. By the 2020 census map, boundaries change, census tracts are merged together, census tracts are split as population grows within those tracts. So just the census tract map itself is very, very different. There's also a change in the part of the criteria that is used to qualify a census tract for designation as an opportunity zone. So under the original Opportunity Zones 1.0, census tracts could have no more than 80%, so median family income of no more than 80% of either the area-wide or the statewide median income. That is being reduced from 80% to 70%, but there's really no other changes other than, as part of the original 1.0, some neighboring tracts, contiguous tracts that were located next to these low-income tracts were also eligible. That goes away. So that's gone. And then there was a special rule for Puerto Rico that was added after Hurricane Maria that made all low-income community census tracts on the entire island opportunity zones. That's also ending effective December 31st, 2026. So because of this reduced eligibility from 80% to 70%, with no other changes in the percentage of tracts that can be designated, we think there's going to be an overall reduction in the number of opportunity zones by about 20% nationwide. So there's 8,764 now. The projected number is going to be closer to 7,000, and with the Opportunity Zones 2.0 because of that narrowed criteria.
Yeah, that's really interesting, just because I feel like that's probably going to take away a lot of the op zones that may have received investments because they might have been a little bit better. I mean, do you have an opinion there? Like, I would think some of those zones that they're taking away might have been better, at least more viable areas to invest into today, potentially. I don't know if you have
I think so. There were a number of census tracts, and it did receive a lot of bad press too, because there were some of these contiguous tracts that received a lot of investment, and those areas weren't seen as being as needy as some of the other low-income communities. So this will definitely focus investment in the low-income communities. There won't be any other options to do that. The selection and the nomination by the governors is going to be an interesting process, because they will still attempt to identify, I think, census tracts that are at least developable. There are some census tracts that would be very, very difficult to develop using opportunity zone investment. And so I think this next round of designations, first, hindsight's 2020. I think when the original designations were made in 2018, nobody really knew what was going to happen with opportunity zones. And now, $120 billion plus of investment later, I think that governors are going to recognize that this is a very legitimate investment program, and that to make sure to identify investments that are identify census tracts that are going to be readily investable.
So let's just take a step back and just talk about Opportunity Zone Program 1.0 versus 2.0, the investors. One thing I noticed was the investors that invested in op zone programs in a lot of cases were investors that normally didn't invest in commercial real estate, because you could, any type of gain, financial gain you had, you could sell a stock, you could sell artwork, you could take that gain and you could invest. And I think in 2.0 it still exists. You can take whatever gain you have that's triggering a long-term capital gains or short-term capital gains. You could turn around and invest that into an op zone program. And I think that holds for 2.0 as well as it was for 1.0. Is that correct?
It does. No real changes there. The House version of the bill included a very small amount of ordinary income that could be invested, so non-capital gain. But that amount was a lifetime amount. It was limited to $10,000, which, while it sounds great, it would have been difficult to raise funds in $10,000 increments. So I don't know how much of an impact that would have had, but it was not included in the Senate version at all.
Yeah.
Our group had certainly recommended at least a higher annual threshold. We were looking at least 100,000, maybe 250,000, just to really boost the amount of investment that would happen in the zones. But that was not included. That recommendation was not.
Yeah, that's unfortunate because 250,000 to me would have made a lot more sense than 10,000.
Right.
But I guess it is what it is on that regard. Just think about real estate for a minute. If you invested in op zones back in 2018, 2019, I guess you got to step up in basis. So if you had theoretically, you had $1 million gain you invested into an op zone fund, and you have that step up in basis. So now your gain is technically in 2026, you're paying based on long-term cap, assuming it's a long-term capital gain to begin with, you're paying tax based on 850,000, right? Based on the
Right.
step up in basis.
Right.
But is it because across commercial real estate, values are down since 2018, 2019, right? Because if you think about it, values are down from peak values in the first quarter of 2022. On average, values across all of commercial real estate are down 20%. Some property types are down on average 40% or more, like office, has been totally disrupted. So
Right.
if and I hate to pick on the office space, we don't make a lot of investments in that space, but assuming if you developed an office building in a op zone back in 2018, 2019, and you invested that $1 million, but the value of that investment today is only, worth $200,000. Are you paying a gain based on, in that example, because of the step up in basis, are you paying based on the 850,000, which would be the, benefit of the step up in basis, or are you paying it based on the current value, which may only be $200,000?
And that's a really nice feature of the opportunity zone incentive, is that the gain that is ultimately paid is the lesser of the amount of the original deferred gain plus any basis step ups and the fair market value of the investment. So if you've had an investment that has decreased in value, if you can support that, you would be able to pay the capital gains taxes on the lesser of the originally deferred gain or your fair market value.
That's the same on op zone program 1 and 2, right?
Same thing going forward. And then you mentioned the basis step up. I mentioned the 5-year deferral. That will be available under 2.0. At the end of that 5 years, investors will get a 10% basis step up for a regular opportunity zone investment. For an investment into a rural opportunity zone, that basis step up will be 30%.
Oh, wow. Okay.
Yeah. There's definitely a focus in really this entire tax bill, but also within the opportunity zone, a portion of the bill to try to drive more investment dollars into rural areas.
So 2 different questions in that regard. One is, how does it work for that step up in basis? Because the last program, it was 10% after year 5, and then you got the additional 5%, right? Which gave you the total of the 15% step up in basis at the end of year 7. Is this, if assuming it's a non-rural submarket, is that 10% at the end of year 5, or is it like 2% a year, or how does that work?
So the original Senate version was going to spread out a sort of a graduated step up in basis over 6 years. That went away. There was actually a change to the bill 2 days ago. Sorry, I feel like I've been up for like 72 hours watching all this.
Right.
There was a change in the bill that made it just a 10% at year 5. At the end of year 5, it's a 10% basis step up. And since there's no longer this calendar date where everyone's going to recognize games, everyone will get a 5-year deferral. So at the end of 5 years, you'll pay your taxes with your next tax return, and then that'll be less 10% of the originally deferred gain, assuming that the fair market value exceeds the value of the deferred gain. If it decreases, you still have this comparison between the amount originally deferred versus the fair market value, and you pay the lesser of that.
So what is defined as a rural submarket? Like, is there a map just set up? Is it similar to
we're working on a map.
Okay.
And there's definitely going to be some confusion around how it's going to set up. Probably won't be 100% determinable until we know exactly which data is being used to determine what census tracts are eligible and what aren't. But the rule that's written into the legislation, and this was in both the House and the Senate, though the House referred to another provision outside of, it didn't give the actual amounts and whatnot. So the Senate version says that a rural opportunity zone is any area that is not located within a town or city with a population of greater than 50,000, or an urbanized area that is adjacent to a city or town with a population of 50,000. How exactly that's going to overlay with the census tract map is still to be determined. I literally had a call an hour with some folks. We're trying to sort out exactly how to make this map look, but that's what the rules are. So if an investor invests into a fund and the fund's investment is into a business or property that is wholly located within a rural opportunity zone, based on that definition from earlier, then that would be eligible for the 30% basis step up.
Okay. And we only have a few more minutes. So, just want to ask a couple more questions. But one is what advice, just given where we sit right now, and I know there's still probably more questions and answers, but hopefully you have a little bit more visibility. What advice are you giving clients right now as it relates to making investments in op zones? Are you, recommending it, or are you saying wait until the new regs are done, or what advice in that regard, or what else are you telling clients based on what the proposed legislation looks like it's going to be as well?
Right. What we're hearing is that, it sort of depends on the nature of the capital gain. If an investor has a capital gain, but they're going to realize, of course, go ahead and invest it, even though if you were able to wait longer until 2027 to realize that gain, then you might be eligible for some additional benefits. So it's definitely something you want to talk to your tax advisors about. To see whether it makes sense for you to go ahead and invest now. It might be a great deal that you want to be a part of. And so you want to go ahead and get your investment in, even though you might be sacrificing some benefit by investing now rather than waiting. It's still something that you should definitely consult with your tax advisor on.
So Jason, tax efficiency is one of the best ways to grow net worth, as we all know. And the OpZone program is an incredible program to be very tax efficient. And it's a great way to really accelerate your net worth, because you can really, as we've talked about, defer capital gains for a period of time. Obviously, you can defer it to 2027. You're really making the payment in 2027 if you invest today on the taxes. But more importantly, with the new program, you can extend it out for 5 years. Assuming you make the investment in 2027, you can extend it out for 5 years before you have to pay that tax, so you can defer it. Plus 100% of the new gain is tax-free, which we haven't really talked about on this episode. But that's the real benefit of the program, is if you invest in a very viable, strong, investment that drives great returns on the back end, and you hold it for 10 years, 100% of the new gain is tax-free.
Right. That's always really been the biggest benefit. We've run the numbers, and well over 50% of the benefit was always in the 10-year hold anyway.
Right.
But that's definitely something that sticks around. There's no change to that. Like you noted, there's no capital gain on the back end of these investments. And that for these real estate investments, that includes no depreciation or capture.
Right.
Which is quite valuable for real estate investors.
I mean, that's huge to not have that recapture. Just from a standpoint of outside of op zones, is there any other program with a new tax bill that comes to light where you're like, investors, individuals, corporations should be focused on to be more tax efficient? Or is there anything changing with the new tax bill that would be interesting from your perspective?
Yeah, there's a lot to change. 100% bonus depreciation is back in, looks like permanently, at least for now. There's a lot of other provisions that are in, a lot of in the community development space, which is where Novogradic works a lot. There's increased low-income housing tax credit benefits. The new market tax credit is made permanent under this. So there's a lot of good community development things, which I include opportunity zones as part of that, are included in this. So definitely something to follow up with your tax advisors on to see what all of this 900 or so pages of tax legislation does for you personally. But there's a lot of good benefits in here.
So just to close it out, really appreciate you joining today. I'm assuming if someone's listening today and they want to hire Novogradic, you're happy to talk to them if they want to, help try and navigate the OpZone program or navigate, some of the other programs with the new tax bill. I would assume, should they reach out to you, Jason, or just reach out to the firm or visit Novogradic's website?
Feel free to reach out to me directly. I would be happy to take any questions and see where people's situations are at and see if we can assist or not. So
yeah,
I'd be happy to do that.
That's great. And, again, thank you for joining. I mean, it's very interesting times, and it seems like we're headed to having the OpZone program continue to be a big part of tax strategies for individuals and corporations and so forth that have these capital gains where they can invest more efficiently. And I think that's great for everyone, especially for these zones, to get those dollars invested and help continue to make these strong investments that have a huge economic impact on a positive side and help create jobs and so forth. So again, thank you for joining us. And this is another episode of Peachtree Point of View. Please continue to join, because we're going to constantly find different interesting ways to either invest capital or trends within investing in commercial real estate and other asset classes. So, please continue to join and listen in to Peachtree Point of View. Thank you.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.